Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're switching gears a bit and we're taking a step back from the stock markets and taking a look instead at bond markets for a lot of our conservative investors out there who may be wondering, where should I go with respect to local bond investing as well as international bond investing in the current investment climate? Well, it's been quite a challenging year, quite a rewarding year on the international investment front. And let's take a look at how 2020 could turn out at both the domestic and international levels. Firstly, we take a look at the domestic side of the market. And when we take a look at the government of Trinidad and Tobago yield curve, we've noticed one major feature, and that has been a steepening of the yield curve. And that means it's becoming more upward sloping with that December 2020 yield curve in pink, certainly showing a much steeper gradient than that December 2019 yield curve. Now, the shorter end of the yield curve, that is investments of 2 years and less, those yields have come down on government securities from 3.1% to just around 2.6%. And that has been attributable to two major factors. One, that excess reserves or excess liquidity in the financial system has been building up, as well as a flight to safety by most investors in quite uncertain times. And that would have dropped yields on the 2 year or less spectrum by around 0.6% or 60 basis points, which doesn't sound like much, but it is quite a meaningful move in investment terms. On the longer end of the yield curve, that is investment theoretically around 80 years to maturity, we can see that there was the opposite movement where there was a 60 basis point or 0.6% increase in yields, and that could be being driven by increased investor uncertainty and heightened inflation expectations, and we'll talk a little bit more about that shortly. Now, in terms of the short end of the yield curve, it was driven by central bank monetary policy in the main, and that would have, specifically, we're referring to a cut in the primary reserve requirement ratio, which was cut in March or thereabouts of 2020 from 17% to 14%, meaning for every dollar raised in deposits by banks, they would have had to put less away at the central bank for safety purposes, and that would have led to a ballooning of excess reserves from its average of between 4 to 5 billion over the past couple of quarters from June 2018 to March 2020 to around $13 billion in the September of 2020. And it's been pretty much stable at around those levels at the last count. So that would have certainly increased the excess liquidity in the financial system and put a downward pressure on short-term interest rates. On the long end, we see that inflation rates have started to climb quite moderately. Food inflation would have ticked up from December of 2019 of just around 0% to the December 2020 figure of around 4.5%. And headline inflation would have started ticking upward to around 0.8% as well. Core inflation has remained relatively flat, but that could be set to change. And why could that be set to change? Well, there is the expectation of high inflationary pressures over the short to medium term, and that would come with the fuel market liberalization, where consumers are going to face floating prices at the pumps in Trinidad and Tobago now, as well as increases in electricity and power rates, or potential increases in electricity and water rates, rather. Overall, though, we still expect low interest rates to prevail at least over the next 12 months or thereabouts, and that is really going to be driven by that persistent excess liquidity on the expectation that the central bank and their monetary policies are going to remain relatively stable, at least for the short term, in tandem with international central bank policy, as well as not wanting to disrupt too much in terms of the financial markets. And of course, increased bond issuance, particularly at the governmental level, is going to be a feature of the investment market in the near term. However, the average investor or everyday investor may be somewhat restrained from participating in those increased bond issuances because most of them are being done via private placement. At the international level, we can see U.S. emerging market indices would have done reasonably well after a rocky start, and we can see around the March to April 2020 figure or timeline that the high yield index, for example, was down just around 20 odd percent, and that would have rallied nicely throughout the year with extraordinary stimulus and monetary policy and accommodative efforts, which would have led to a 7.6% advance overall for the year for both high yield and the investment grade indices. So certainly bond investors would have been comforted somewhat with the extraordinary stimulus as well as accommodative monetary policy efforts that would have helped to prop up bond markets to some extent. And that would have filtered through into local US dollar or Trinidad and Tobago US dollar bond prices. We can see that currently in that turquoise or teal color, bond prices are trading at or near their all-time highs. For example, the Trinidad and Tobago 2026 government bond is trading at around the price of 109, which is pretty close to its all-time high of 110, after falling to as low as $84 per $100 face value at the peak of the global pandemic crisis and its effect on investor sentiment. So internationally, we can expect low interest rates as well in the US and other major major regional markets, and that's again accommodative monetary policy and extraordinary stimulus. Inflation is less of an issue in our view for the US as well as other developed markets over the short term, because even in good times they would not have been able to hit their inflation targets. Increased market volatility we expect to be less likely, given again central banks as well as governments doing whatever it takes to stabilize financial systems, at least in the near term. However, credit rating downgrades is going to be more likely as the reality of real business takes a hold of certain weaker credits in the international space. So for investors with this period of heightened uncertainty and a low interest rate environment, we can expect lower interest rates or yields in a prevailing environment. We can expect increased private issuances at the domestic level. So investors may wish to consider shorter-term alternatives amidst the heightened uncertainty if they do not want to take that risk of going longer at this particular point in time. But that's it for this week's edition. For more information, you can give us a call at 2-BORSE or 226-8773. Check out our website at borseinvestment.com, or of course, email us at invest@borsefinancial.com. Have yourselves a wonderful investing week and see you next time on the Bourse Report.